Good
Good
morning.
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 All right, I'm ready whenever you are, Maria.
All right. Good morning, everyone. This is Maria Fernandez. I use the she, ella pronoun. I do leadership development at Mass Union, and you are here on our webinar that we have today dealing with rent changes. This webinar is going to be led in partnership with our colleagues at EOHLC, and I'll let them, well, in my introductions, I'll tell you what that acronym means, but that's the State Department for short. A couple of housekeeping. Please mute yourself. This is going to be a presentation, and then at the end of the presentation, we'll have a question and answer session. If you do not mute yourself, we will mute you, because it's unfair for our presenters to have to deal with background noise and try to get you the information that you need. So that's that. If you want to ask questions and you fear that you will forget it, please pop it in the chat, and Lilith will monitor it, and we'll put you in the queue. So when it is time for questions and answers, we'll have it there and you will not have forgotten it. Lastly, we appreciate all the times that you have been interested and shown up and participated in our training series. We're working on curriculum development for 2025, so stay tuned for more trainings in the new year. With that said, I want to introduce the presenters for today. First, we have Carrie Sousa. She is the Associate Director of the Bureau of Housing Management. Carrie has served in various roles at EOHLC for 18 years, 7 years as a housing management specialist within the Bureau of Housing Management, 7 years as a contract manager with the Division of Housing Stabilization, and the last 4 years, she rejoined the Bureau of Housing Management as an associate director. So welcome, Carrie. Bill.
Good morning, everyone.
Thank you, Carrie. Bill Halfpenny is counsel for EOHLC, and counsel, for those of us who are not in the legal world, that means he is the attorney. He is the one that makes sure that the State Department is in compliance with all of the things. He has worked in the department for 5 years. In that time, he's primarily worked with the Division of Public Housing, advising the Bureaus of Housing Management and Housing Development and Construction on legal matters. Prior to joining EOHLC, Bill was a landlord tenant attorney in the private sector. Their colleague Melanie is here. Melanie, do you just want to say hi? I don't have your bio, but I just want to give you the opportunity to say hi.
Sure, thank you. I'm a housing management specialist, senior housing management specialist at EOHLC, which is the Executive Office of Housing and Livable Communities, DHCD for everyone who's been around for a while.
Thank you, Melanie.
You're welcome.
All right, so I'm going to turn it over to these folks, and they're going to show you a PowerPoint presentation. And as I said, questions will be at the end. If you fear you'll forget questions, pop it in the chat. Thank you.
Okay, I'm going to share screen, and I'm going to set this up on my screen. Okay, let me know, folks, if we're able to see it in just a second. So, is everybody seeing that first slide?
Yes.
Okay, awesome.
Yep.
Thank you.
Okay, so I could kick us off. Maria already very kindly did the introduction, so I'll skip those, but I am Bill Halfpenny. And today, me, Carrie, and Melanie are going to walk you through the changes to EOHLC's Occupancy Standards and Tenant Participation Regulation, which is 760 CMR 6. And that's where all of the regulations on rent determinations are located.
Some of those goals include promoting economic mobility, allowing tenant households to keep more of their income by adjusting income exclusions and supporting efforts to save, encouraging investment in training and educational opportunities, supporting family members who need personal care to remain independent, helping to ease the financial strain on individuals with disabilities, and supporting veterans and their families.
Okay, so before we dive into the actual changes in the regulations, I want to just take you through a brief look at the regulatory process and how we got here. So these changes took a long time to come to fruition. We actually started them back in 2019 when EOHLC, which was then DHCD, met with Mass Narrow, Mass Law Reform Institute, and the Mass Union of Public Housing Tenants to discuss the changes that we wanted to make. Once we'd settled on the amendments we wanted to enact, the process crawled ahead through COVID, a change in gubernatorial administration, and the change from DHCD to EOHLC. Finally, in January of 2024, we received the approvals that we needed to post the proposed amendments for public comment. That comment period was open through January 26th, 2024. And following the close of the public comment period, we did make some small technical edits, and we went through the process of obtaining the final approval to promulgate the regulations. We received that approval, and the amendments were finally promulgated on June 7th of this year.
Here are the changes that we'll cover today. Student income. Expanding the definition of student to include half-time students as well as full-time. PCAs. Allowing family members to serve as a PCA. Asset income. Calculating imputed interest on assets only when they total $25,000 or more. Gifts. Simplifying how we treat gifts from non-household members by only including gifts when they total more than $5,000 in any 1 year. Stipends. We are supporting tenants who volunteer for nonprofit organizations and receive a stipend by excluding a portion of the income received. Training programs. Expanding the kinds of on-the-job training programs that can be excluded from income to include apprenticeship programs. Codifying guidance provided during COVID that makes it clear that the elderly wage exclusion also applies to unemployment, workers' comp, and long-term disability payments. Exclude payments paid to or received from a special account designed to assist disabled individuals called ABLE, Achieving a Better Life Experience. An exclusion for special veterans benefits received twice a year under Mass General Laws, Chapter 115, Section 6B. Deductions for tuition and fees at a vocational or post-secondary educational program. Increased funding for LTOs from $6 to $25 per unit. And finally, updated heat deductions. So let's go through each one.
Okay, let's start with the exclusion of student income. So previously, only wages of full-time students were excluded from gross household income. 760 CMR 6.053K was amended so that now wages or salary earned by an at least half-time student are excluded from gross household income. We believe that doing so will allow for greater flexibility for residents of public housing to attain higher education on a time frame that meets the residents' need. You may be wondering, however, what exactly a half-time student is. For that, I'll turn it over to Carrie.
Here is the new definition of half-time student as it appears in the definition sections of 6.05. I'm not going to read all this. Instead, let's look at the eligibility requirements in the definition.
So let's look a little closer at that definition, breaking it down into its various requirements. First and foremost, for someone to qualify as a half-time student, the person claiming half-time student status must be a household member. So that's simple enough.
The half-time student household member must be between the ages of 18 and 26 at the time the exclusion is claimed.
The next requirement that needs to be met for someone to meet the definition of half-time student is that the person claiming half-time student status must be the dependent of another household member.
They must be enrolled and attending either an accredited educational or a vocational institution.
Okay, and now for the fifth and final requirement contained in that definition. The person claiming half-time student status must be carrying a course load considered at least half-time for students under the standards of the institution. Now, not every school is going to have a formal half-time program, and if a school doesn't have a half-time program, then the household member claiming half-time student status must be enrolled in a course load that is at least half the course load required for full-time students at that school or institution. Before we move on, let's quickly recap the requirements to be eligible. The person claiming half-time student status must be a household member. They need to start their education between the ages of 18 and 26. They need to be the dependent of another household member. They need to be enrolled in attending an accredited educational or vocational school, and they need to carry at least a course load considered at least half-time. So now that we know the requirements for claiming half-time student status, let's talk about how long half-time student status can last. First and foremost, half-time student status remains in effect only as long as the student claiming half-time student status carries at least a half-time course load at an accredited educational or vocational institution. If a student stops their course load, they no longer maintain their half-time student status. But those aren't the only limits on the length of half-time student status. The regulation also states that it can last twice as long as it takes the full-time student to complete the required course of study, which would be 8 years. But there is some leeway. That time frame may be extended an additional 2 years for 10 years in total, with verification from the educational or vocational institution of ongoing enrollment and credit attainment. So a few more thoughts on half-time student status. Times will vary based upon the course of study of the individual student. It's based on the time frame of study from that educational or vocational institution. And eligibility is based upon the age of the student when they claim the exemption. This is important. The student claiming the exemption must be between the ages of 18 and 26 when they claim the exemption. But as we saw in the last slide, the exemption can last for up to 10 years, meaning someone may and is probably even likely to be over the age of 26 and still receiving the exemption. And just to note that half-time student status can still be claimed when changing a course of study. So if a person stops their studies, half-time student status ends, but a change in what the person is studying still qualifies the person for half-time student status.
Before we move on, you may be wondering what happened to full-time students. Don't they qualify for an income exclusion anymore? They most certainly do. Although the definition title in the regulation references half-time student, the definition makes it clear that full-time students who meet the eligibility requirements receive the same exemption. To qualify, the student must be carrying a course load that is considered at least half-time. So with this language, full-time dependent students qualify. Full-time student status is to last as long as the individual is enrolled in a full-time program. So likely 2 to 4 years, depending on the degree that is being sought, with the option to extend full-time student status an additional 2 years at the LHA's discretion.
Okay, so those are the changes to the exclusion of student income. Let's take a look at the next change in the regulation, which relates to personal care attendants or PCAs. The definition of PCA, that's at 760 CMR 6.03, has been amended to allow a family member to serve as a PCA. Looking at this new definition, you'll see that nowhere in there does it say a family member can serve as a PCA. What's key is the language that we removed from the old definition. Previously, there was language in the definition that stated that a PCA could not be living in the unit except to provide necessary assistance to a household member with a disability. This language made it clear that a family member living in the unit could not qualify as a PCA. That language has now been removed from the new definition, which has the effect of allowing a family member who lives in the unit to serve as a PCA. A corresponding change has been made to 760 CMR 6.053L regarding the exclusion of PCA income. As previously written, 6.053L did not provide an exclusion for income of a family member PCA. That language has been deleted to correspond with the change to the definition of PCA that now allows family members to serve as PCAs. But let's take a step back and look more closely at who exactly qualifies to serve as a PCA. First, they must reside with a household member with a disability. Second, they must provide assistance with activities of daily living required by the household member with a disability, and the disability-related need for a PCA may be verified through a physician or medical practitioner. Third, the PCA cannot be obligated for the support of a household member. Now, this does not mean financial support. It's referring to a legal obligation to care for another. This means that a PCA cannot be the spouse, parent, or foster parent, or other legally responsible decision maker for the household member with a disability. And finally, the PCA must be paid for their services. In Massachusetts, PCAs are paid by MassHealth through a fiscal intermediary called Tempest Unlimited. Someone not paid through the MassHealth PCA program for their PCA services does not meet the definition of PCA contained in the regulation. Some final points on PCAs before we move on. A full-time live-in PCA is understood to be a PCA working at least 20 hours per week as a PCA. Pursuant to 760 CMR 5.03, which means this is not a new change, just a reminder, a full-time live-in PCA, if determined by a housing authority to be qualified, must be considered a household member for purposes of determining appropriate unit size. If a household member wishes to add a full-time live-in PCA to the lease, the full-time live-in PCA may be added in accordance with the definition of family household that's in 760 CMR 5.03B and Section 12 of your state-aided public housing lease. Now, regardless of whether a PCA has been added to the lease, PCA income should be excluded. A PCA that is added to the lease is eligible to be considered a remaining household member if the person with a disability who the PCA provides services to ceases to occupy the unit. Okay, that does it for PCA income. Let's look at the changes in the regulation related to asset income. I'll turn it back over to Carrie to kick us off.
Yeah, let's give Bill a break here. The inclusion of asset income appears in 6.05 Section 2, inclusions in gross household income in paragraph C. The new regulation calculates assets in the same way. However, it raises the threshold to apply imputed asset from $5,000 to $25,000. Currently, LHAs include the actual income from assets under $5,000 and the imputed or actual income for assets over $5,000, whichever is greater. The upcoming change increases that asset threshold to $25,000.
So I think we fell a slide behind here, but this is, that's the definition that Carrie was just talking about. And then here on this slide is a visual representation of what Carrie just discussed. When assets are less than $25,000, the housing authority should use the actual income from the asset to include in gross household income. And when assets exceed $25,000, the LHA should use the imputed or earned income from the asset, whichever is higher.
Let's take a look at an example. The Banks family has $24,000 in assets. So the LHA includes the actual income from the asset. The Green family has $27,000 in assets. The LHA reviews the actual income versus the imputed income, and whichever is higher or greater is included in household income. The tenant provides documentation on the assets. Then the LHA verifies the assets. It's either income earned on asset is verified to be $500 versus the imputed asset interest of 1%, which turns out to be $270. The LHA includes the higher amount, which is $500 in household income.
Okay, so those are the regulation changes that are related to assets. Let's shift gears to the changes related to gift income. And Carrie can start us off again.
We've simplified the language regarding income from gifts, contributions, and gifts. You only include gift income if the household receives more than $5,000 in gifts in a 12-month period. This means a total of all contributions or gifts received from a non-household member. They can be from a single source or multiple sources. If the total is more than $5,000, then you include any amount over the $5,000.
Okay, let's do an example. At redetermination, Jonah reports that he received some gifts and contributions during the previous 12 months. These include a $1,000 gift at Christmas from an aunt, a total of $2,000 over 3 months from his brother to help with bills, and $3,000 from a GoFundMe account. Let's determine how much of Jonah's gift income is included. The answer is $1,000. $1,000 of Jonah's gift income is included in gross household income. This is because Jonah received a total of $6,000 in gifts, and the new regulation says to exclude up to $5,000 in gift income. So 6,000 minus 5,000 gives us our answer of $1,000 in gift income included in gross household income. Okay, moving right along from gifts, let's look at the changes related to volunteer stipends.
The first to qualify are payments received by participants in a program pursuant to the Domestic Volunteer Service Act of 1973. This did exist in the old regulations, so you're probably familiar with this.
And so you're probably wondering what exactly are programs under the Domestic Volunteer Services Act. There are a number of different programs, and you'll need to look at the program language or the legislation to know for sure. But the most common and the most famous is the AmeriCorps Vista.
In addition to including programs funded pursuant to the Domestic Volunteer Service Act, we have expanded the exclusion to also exclude stipends received by volunteers for activities performed on behalf of a tax-exempt nonprofit organization or foundation or an accredited educational or vocational institution.
But note that there is a cap on this exclusion. Only the amount of stipends equivalent to the wages of a person working 20 hours per week at minimum wage are excluded. Everything above that is included in income. We've done the calculation for you here. 20 hours per week at the current minimum wage comes out to $15,600 per year. So a volunteer can exclude up to $15,600 per year as volunteer stipends.
And here's an example. Natasha volunteers for the Boys and Girls Club in the after-school program. The Boys and Girls Club is a tax-exempt nonprofit. As a volunteer, she receives a stipend of $2,500 a year. This stipend does not count as income. The Boys and Girls Club is a tax-exempt nonprofit. The total amount of her stipend is below the maximum allowed by the exclusion. Again, the equivalent of 20 hours per week at minimum wage or $15,600.
The next amended section of the regulation relates to employment training programs, on-the-job training, and apprenticeships. Let's look at how those exclusions work.
Let's look at what may be excluded. The language provides an income exclusion to a household member who is receiving payments or wages in an on-the-job training or apprenticeship program. The new language is highlighted in yellow. The exclusion has been expanded to recognize apprenticeship programs. We've also added language to the cap, the amount of the exclusion, which Bill will discuss more in the next slide. Note that the head of household could qualify for this exclusion.
So that's the exclusion, but there are some limits that you should be aware of. First, the exclusion can be claimed for a maximum of 2 years. And the total amount that can be excluded is capped at the amount of wages received by a person working 37.5 hours per week at 1.5 times the minimum wage. You don't have to do the math, we did that for you. And it comes out to $43,875 per year. And again, that can be claimed for 2 years.
Okay. Robert is an apprentice machinist with the MBTA. He earns $56,236 per year. How much of his income can be excluded in year one? The answer is the maximum allowable of $43,875.
Okay, moving right along to the next change. This one deals with an expansion of the senior wage exclusion.
What is new here is that we have codified guidance issued during COVID that makes it clear that the elderly wage exclusion also applies to unemployment insurance, workers' compensation, and short or long-term disability payments. The current regulation only mentions wages. This is a change that protects elderly residents from a situation in which they are working and have wages excluded. Then they lose their job and receive a rent increase because they're getting unemployment. The regulation now clearly states that those benefits may also be excluded. However, the language capping the benefit at the equivalent of 20 hours per week at minimum wage, which is $15,600 annually, remains the same.
Simple enough, so we'll keep it moving. The next change relates to payments and benefits from Achieving a Better Life Experience accounts, or ABLE accounts.
As Bill said, ABLE stands for Achieving a Better Life Experience. These are tax-free savings accounts for individuals with disabilities. The law aims to ease financial strains faced by individuals with disabilities by making tax-free savings accounts available to cover qualified disability expenses.
Some quick notes on ABLE accounts before we move on. Each state administers the ABLE program, and eligible persons can apply in any state, but they can only have one ABLE account. The Massachusetts ABLE program is called Attainable Savings Plan, and the state administrator of that program is the Massachusetts Educational Financing Authority, or MEFA. The person with signatory authority can withdraw and deposit funds into the account, and withdrawals and deposits would appear on a statement from the administering agency, which again is MEFA.
Okay, everyone, just hang with us. I know we've gone over a lot of stuff, but we are getting close to the end. So now let's look at the language that provides a new income exclusion for veterans and or their families. This is found in 6.053S.
This change relates to annuity payments made to veterans pursuant to Massachusetts General Law, Chapter 115, Section 6B, more commonly known as the BRAVE Act. These annuity payments are made to certain disabled veterans or to the parents or non-remarried surviving spouses of such veterans who are deceased. These annuity payments are $2,500 per year, paid in a single installment. And this is a slight change from how it used to work. Previously, qualifying veterans received $2,000 in the form of two $1,000 payments, but recent legislation has increased it to $2,500 and made it a single payment instead of two. To qualify for the exclusion, the benefits must cite the BRAVE Act, which again is Massachusetts General Law, Chapter 115, and all of the benefit monies are excluded from income.
The final rent-related section that we will cover today relates to the deductions for tuition and fees that appear in 6.054H.
So we're now out of the realm of exclusions and into deductions. And as Carrie mentioned, we made a change to the deductions for tuition and fees. Pursuant to 760 CMR 6.054, a household can deduct non-reimbursable payments of tuition or fees for vocational or secondary education. Now, previously, vocational education was not included in this deduction. So with the change, the deduction will apply to more individuals. Do note that the deduction and any deductions for the care of children and for child support cannot combine to exceed the income that is included in gross householding.
Currently, the regulation only obligates LHAs to rekey the locks of a household member who has experienced domestic abuse if the tenant has received a restraining order against the abuser. The upcoming change, which is being made to correspond to a change in the law at Mass General Laws 186, Section 26, would obligate LHAs to rekey the locks within 48 hours for tenants or household members under imminent threat of domestic violence, rape, sexual assault, or stalking.
So there's some nuance here that I want you all to be aware of. Where the abuser is a tenant or household member, the request to rekey locks has to be accompanied by a copy of a valid protective order or a record from a federal, state, or local court or law enforcement agency indicating that the abuser, tenant, or household member poses an imminent threat of domestic violence, rape, sexual assault, or stalking. Conversely, where the abuser resides outside of the tenant household, a request to rekey locks does not need to be accompanied by a protective order or some other order that I just went through, and an LHA cannot require it.
The upcoming change makes the 6-month grace period for over-income tenants mandatory rather than discretionary, and allows, but does not require, LHAs to provide over-income tenants with an additional 6-month grace period. This change is in response to the increasing cost of rental properties and a continuing tight housing market.
Okay, we're almost at the end of our regulatory changes. There's one more regarding local tenant organizations, or LTOs, that we want to make you aware of. The per unit amount that LHAs are required to fund LTOs has been increased from $6 per state aided public housing unit to $25 per state aided public housing unit. Prior to this change, the per unit dollar amount hadn't been updated in decades, and tenants and advocates for LTOs have indicated that LTOs were being insufficiently funded. To receive the funds, the LTO needs to provide a budget to the LHA and receive the LHA's approval. At the end of the year, the LTO must submit a financial statement accounting for all LTO income from the state aided housing portfolio and all expenditures of such funds in accordance with their approved budget.
The funds are for ordinary and necessary business expenses such as paper, copying, mailings, and on authorized activities such as LTO meetings, tenant outreach, and fundraising. These funds cannot be used for social activities.
So we've gone through all the regulatory changes. Thanks for bearing with us as we went through them all. But before we finish, I want to make you aware of another change that exists outside of the regulations to the EOHLC heat deduction schedule, which has also recently been updated. The values in the old heat deduction schedule were 30 years old, and they are very outdated. To better align with today's utility prices, we increased the values in the schedule. And additionally, EOHLC adopted a second heat deduction schedule, which applies to those whose heat had been converted from natural gas to electric heat. We recognize that the cost increase associated with that sort of change can be a burden. So we've provided a higher deduction for such a situation.
This is a copy of the heat deduction that is available for all tenants to have a look at. Again, as Bill said, it hasn't been changed in 30 years. The new schedule will apply to those who convert from natural gas to electric heat. The new heat deduction schedule was released as attachment C to the Public Housing Notice 2024-07, which was the promulgation of amendments to 760 CMR 6, and which became effective June 7th, 2024.
Okay, so that's it. Thanks for listening to us. We're done presenting and we can open it up to questions.
Thank you.